I want to welcome you to the 7th lecture in International Economics and Finance. And as we finished the part about international trade, we're going to move to international finance or international macroeconomics part of the course. And we're going to start with some general information about foreign exchange markets. Okay, so let's start by outlining what we're gonna talk about today. We're gonna start with the explanation what are the spot exchange rates, and we're gonna see how they behave over a longer period of times. Then we're gonna move to the forward markets, and we're gonna learn about instruments used in those markets. Then we're gonna discuss the concept of effective exchange rates as a measure of the overall behavior of exchange rate of a given country. And then we're gonna talk a little bit about trading volumes. So what actually is happening on the foreign exchange markets. Okay, but let's start with some basic terminology that you probably remember very well from different classes like macroeconomics. Okay, exchange rate is a price of one currency expressed in terms of other. Right? So basically it tells us how many units of one currency we need to exchange for 1 unit of other currency, or how much are we going to get for 1 unit of the currency we have. Now, then very often in macroeconomics classes, you were using terms depreciation, appreciation. Depreciation means, of course, decreasing the value of currency, which means that for 1 unit of our currency, we can get less units of a foreign currency. Well, the opposite situation is when we have appreciation. So this is simply increase in the value of one currency, which means that now with 1 unit of, let's just say, domestic currency, we can buy more units of foreign currency. Now, the two additional terms very often used in the context of exchange rate markets are devaluation and revaluation. They are to some extent counterparts of depreciation and appreciation in the context of fixed exchange rate regimes. So if the government deliberately adjusts the value of the currency downwards, we call it devaluation. On the other hand, if the government deliberately adjusts the value currency upward, we're going to be talking about revaluation. Now, let's talk about something that might be new to you. Look, every time when we were talking about exchange rates in Introduction to Economic Analysis, for example, or when you were talking about macroeconomics or intermediate macroeconomics, you were actually talking about spot exchange rate. And spot exchange rate is the price of buying or selling currency at present moment in time. So look, this is how much you can get for 1 unit of your currency if you're gonna sell it today. Okay. So now that we know what are the spot exchange rates, maybe let's look how they behave over time. So look here, what you can see are actual exchange rates I got from ADWFNCOM, which is an amazing page about generally prices of different assets or even cryptocurrencies, but they have enormous bank of data on trading currencies, and I really encourage you to use this page to learn how currency trading works in practice. Okay, so look, what I have put in this table is the price. So this is spot exchange rate of euro in terms of other currencies, right? So look, what what do we learn from this? You know, first we've got this bid and ask. Well, because remember, there is like when you go to exchange, when you want to go on a vacation and you need to buy a foreign currency, you also had bid and ask. Ask is sometimes called also an offer. Prices, and look, bid price is actually slightly smaller than ask price, because ask price is how much you need to pay if you want to buy currency, and bid price is how much given institution, a bank for example, offers you if you're going to sell them your currency. So bid, in other words, is how much they are going to pay for your currency, and ask is how much they are going they are going to charge you if you're going to buy currency from them. Uh, yeah. Okay. So for example, here we see that if you want to buy one United States, if you want to buy 1 euro, you need to pay approximately $1.19. Well, if you're gonna uh, 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 if you're gonna sell euro, you're gonna pay. I'm sorry. You're gonna have to pay $1.19, and if you're gonna buy euro, uh, uh, you're gonna pay $1.19 as well, but with the bigger with the bigger amount after the decimal spaces. Okay, so look, we see that ask is of course bigger than bid, because the institution that is selling you this wants to make some money. Now, the money that they are going to make on each transaction is called spread. This is a difference between ask, so the price at which they are selling you the currency, and minus bid, so the price at which they are buying the currency from you. And look, in this case, it's 0.0006. You might say, well, this institution might will not be able to make a lot of money. And of course, if you talk about the exchange, when you're a tourist and you want to exchange your currency, that of course is true. But those spot exchange rates that I'm showing to you here, they're actually the ones offered by banks. So look, usually if you want to participate in transaction like this, you need to have millions and millions of euros, or millions and millions of dollars, millions and millions of pounds, and then you can actually the institution that makes the exchange can actually make some money on it. Of course, when you see it, when you go to another country, the spread is a little bigger, because with smaller transactions, the exchange must make more money. Now, the spread usually is expressed in terms of percentages. So look, here you have the formula. It's simply spread divided by ask price, so the higher one, times 100%. And again, we see that in this case, this is 0.005 of a percent in case of US dollars. Now, why spreads are so small? Look, if spreads would be big, it would mean that you can make arbitrage to make some money. You could buy currency at one place, exchange it in another, and make a profit because of it. So generally, spreads are very, very thin, and the rule is the more the two currencies are traded, the lower is the spread. And look, we can clearly see that in case of euro exchange to United States dollars, where spread is far smaller than the spread between Polish zloty and euro. In context of Polish zloty and euro, where spread is bigger, simply because those currencies are traded less than United States dollars and euro. Okay, but look, because those spreads are so very tiny, we actually are not going to consider two different prices, ask and bid, in our further considerations. We're going to consider like medium price, which is simply an average of the two, and we are going to call it spot exchange rate. Now, I want you to notice one more thing. Next to the table over here, I put the date, but not only the date, I also put an hour at which I retrieved those exchange rates. Why did I do so? Well, because exchange rates, even though they are prices, just like prices of goods you can buy at a store, they have very specific characteristic that you are not going to find with any other goods. When you go to a shop to buy some milk, and you see that milk costs $2, but let's just say you want to buy some other things first and you want to buy milk at the end, you expect that the price of milk is going to be the same. And this is generally true for prices of most of the material goods. They seem to be stable over time. This is not true in case of not true in case of prices of currency. So this is not true for exchange rate. They change not only on a daily basis, they change sometimes from minute to minute. And look, like every price, they depend on demand and supply. And because in foreign exchange markets, they tend to move very, very quickly, this impacts, of course, the changes in exchange rates. Okay, so now let's move on to how those changes look over time. Oh, one more thing. Look, what we are discussing here are bilateral exchange rates. What does it mean? It means that we are talking about price of one currency in terms of other. Okay, now, for example, let's look at this table. Here we have bilateral exchange rates. Usually tables like that are called forex cross rates, because in this table we can get prices, price of two currencies expressed from the perspective of one country or the other. Okay, and now let's look what do we see in this table. First, over here, I see how many pounds do I need to spend to buy $1, right? So in order to buy $1, in order to buy £1, in order to buy $1, I need to pay 0.49, 0.75 of a pound. Over here, what we see is how many dollars we need to pay for £1. So I need to pay $1.33, so $1.33 if I want to buy £1. Now look, how can I get this number having this number. Well, this is very simple. I take 1 and I divide it by exchange rate, and I'm getting the other exchange rate from the perspective of the other country. So look, those two numbers are very closely connected. And look, we see the same phenomenon over here. Here we see how many pounds I need to pay for 1 unit of euro. It's approximately 89, 90 0.9 of a pound, right? And here, what I see over here is how much euros I need to pay for 1 pound. And again, if I take any of these values and I divide 1 by this value, I'm going to get the other. So look, we see here this bilateral exchange rates, and we can calculate each one from the other. Again, there is one more thing that should be noted over here. The thing that should be noted is that I should be able to get any price of any currency over here by enough manipulations like that. Why? Well, if we would have an arbitrage, so-called triangle arbitrage. So for example, there would be I could make money by selling pounds for US dollars, then selling dollars for euro, then people would take advantage of it. They would make arbitrage transactions, and they would be making them for as long until the price of those currency wouldn't get within the limits set by the exchange rate. So there is no further possibility to make a profit. So again, any exchange rates that you can see over here, you can always calculate through enough intermediary countries. But let's notice a couple other features of this table. Okay, so one thing that we can notice is that some numbers are red, while other numbers are green. Well, red number denotes depreciation of a currency, and green number means appreciation of a currency. Okay, look, here, for example, you see that the value value of a pound in terms of United States dollars is green, while value of United States dollars of dollar in terms of pounds is red. And look, it makes perfect sense, because if from one perspective, when one currency appreciates, the other must be depreciating. So of course, if one currency increases in value compared with the other must be losing in value compared with this currency. So as you see, usually we expect half of this table to be red and half of it to be green. But then you might say that there are some exceptions to this rule. We see, for example, that exchange rates between Norwegian krona and Brazilian currency is in black. Why is it like that? Well, it's because they maintained at the same level. So this is a situation where we had neither appreciation nor depreciation. Another thing that you might notice is that what we see over here, like this one, when we talk about euro and Japanese yen, here we see appreciation, but here we see black number. Why is this happening? Well, because look, 1 euro can be exchanged for 124 Japanese yen. So when we divide one by this exchange rate, we get a number so low that simply the program did not count it enough spaces, decimal spaces after the comma, to account for the change. We see this with the bigger value, but we don't see it with the smaller one. Okay. And finally, the last example that you might see is again associated with Brazil, but this time with Poland. Because those currencies probably are traded so little, we don't even have the results. And we don't have the results because in case of this site, there was not enough transaction to actually calculate the appropriate exchange rate. Okay, and now finally we can move on to exchange rates over time. Okay, so look, here we have exchange rate of euro expressed in terms of dollars. So what we see over here is how many dollars I can get for 1 euro. Okay, look, this data that you see over here is actually the daily data. This is why this entire this entire graph is full of these sharp edges. Now, I also eliminated from the data the days at which currencies were not traded. Like usually currencies for foreign exchange markets are closed on Christmas, so there's no trade taking place. Okay, and let's notice a couple of things. Look, we clearly see that the price of the two currencies is changing from day to day. But sometimes it changed by more, sometimes it changed by less, but definitely volatility is one of the very characteristics of the exchange rate. Okay, but let's go back to the basics. Look, we see that at the beginning, for 1 euro, we could get less and less and less dollars. So we see that in this case, euro actually depreciated while dollar appreciated. But look, this tendency reversed for a very long time, of course, with swings. We see that in the right up till 2010, so roughly to the sovereign debt crisis, well, which started, I'm sorry, 2009, so roughly up till the foreign debt crisis, sovereign debt crisis in Europe, euro was appreciating. Then it started to depreciating, and it stabilized around 2015, and it's maintaining roughly between $1.1 and $1.20 for the time being. But clearly, we see here that there is great deal of volatility. This volatility in exchange rates is something that needs to be accounted for by econometric models and economic models that we are going to use to describe the behavior of exchange rates. Now, over here, we see the exchange rate of euro against Polish zloty. Okay, and we see here again that since between 2000 and 2002, euro was depreciating and Polish zloty was appreciating. But we see clearly here that between 2000 and 2010, there was a lot of swings. And you can see it as as we hear this peak around 2004, when a Polish zloty depreciated so much that you needed to pay almost 5 zlotych for 1 euro. But at the same time, in the midst of a financial crisis in 2008, we could buy 1 euro with not much more than 3 złota and 20 groszy. Then we saw that there was another swing. Euro appreciated, Polish zloty depreciated, and then again euro started depreciating in the midst of sovereign debt crisis. And then the price, even though still volatile, is relatively stable, and it centers around somewhere between around, let's just say, 4 zlotych and 30 grosz. Yeah, one of the features that you might notice is that actually the exchange rate between Polish zloty and euro is more volatile than an exchange rate between American dollar and euro. But talking about great changes and volatility, we should remember one thing. Look, here, if I would calculate some average value for the entire period, I probably would get something like 4 zlotych and 10 groszy, maybe 4 zlotych 15 groszy, which, as you see over here, is still not that bad. And why am I saying that this volatility is not so great? Because in the next graph, we have Russian ruble. And here you see that actually at the very beginning you could sell 1 euro and actually get around 29 rubles. But at the after 20 years, now we can sell 1 euro and buy around 94 rubles. And look, here we actually see not only volatility around some trend value, but what the thing that we see over here is a secular movement towards depreciation of Russian ruble. Like euro appreciated against Russian ruble greatly, and by the same token, we can say that the Russian ruble depreciated greatly, and in this case, we see, you might say that there is very little volatility over here. Look, over here, there is far more volatility than you would see in the graph of Polish zloty, and definitely in in graph with United States dollars. Why? Look, because the scale here is so big that even though those changes here are 5, 7 rubles, still they seem very, very tiny in comparison with what was happening between 2012 and 2017, where you see enormous swings in the value of currency, which can be devastating for the Russian economy. Okay, but look, let's put those in perspective. If I'm going to put in one graph volatility, exchange rate of euro against Polish zloty and United States dollar, we see that definitely Polish zloty is that exchange rate between euro and Polish zloty is definitely more volatile than between United States dollars and euro. However, if I'm going to add now on this graph Russian ruble, you see that again volatility of the first two is becoming basically insignificant. Okay, so look, what have we learned now is that we have spot exchange rate. So this is a price we can get for one currency at present moment in time. But look, this is not the only possibility at our disposal, because we also have forward markets. And let me first illustrate to you why do we even need forward markets. Okay, and let me illustrate this with an example. Let's just say that we've got a Polish company, and that Polish company is selling bikes to Germany at a price 1,000 euro per bike. Now, the company has a contract with some store in Germany to deliver 100 bikes half a year from now. Okay, so in this situation, we see that Polish company needs to produce bikes now, deliver them half a year from now, and the company is going to be paid 1,000 euro per bike, but half a year from now. Okay, now let's just say that the cost of production and transport of one bike is simply 3,000 zlotych. Okay, so now let's define some basic categories. Let's just say that S is price of zloty, price of euro expressed in zloty. So it's simply number of zlotych divided by number of euro. So we see here how many zlotych we're gonna get per 1 euro. Let's say that P euro is price expressed in euro, while P zloty is price expressed in zloty. Now, the average cost of producing and delivering one bike is denoted by AC, and this average cost is also expressed in zloty. Okay, so now, how does the profit function for this company look like? Look, this is simply total revenue minus total cost as usual, but let's see what we have over here. We have over here that we are selling in Germany, so we're gonna be getting euros. So we will have price times price expressed in euros times how many bikes we sold, minus, of course, average cost times of producing one bike times how many bikes we sold. But of course, this average cost is expressed in zloty. So look, in this equation, this part is expressed in euros, while this part is expressed in zlotys. So what we need to do is to use the exchange rate to change euros into zloty. And because of that operation, we're going to have total revenue expressed solely in terms of Polish zloty. And this is the revenue that is important for the company that is located in Poland. Okay, so let's see what can now happen within this half a year. Okay, let's start with a situation like that. Let's just say that current exchange rate is 1 euro for 4 zloty. What does it mean for our company? Because our company is selling bikes at the price 1,000 euro per bike times 100 euros. Now, cost of producing one bike is 3,000 zlotys times 100 bikes. We can get a number of zlotych we get for one bike by multiplying by exchange rate, and we get that this is 4,000 zlotych per one bike. And look, in this scenario, the company is able to make a profit of 100,000 zlotych, which seems like a very good deal for this company. But look, what would happen if in the meantime, so in the half a year, from the point where you produce the bikes, made a contract with the company to deliver the bikes, price of euro would drop. So euro would depreciate it, zloty would appreciate, and let's just say that now for €1 you can get only 2 zloty. Okay, still we need to make exactly the same calculation in terms of profit, but look what we get now when we change euro price into Polish price. We use different exchange rate, and as a result we see that the company is getting only 2,000 zlotych per one bike, which translates now into 100,000 zlotych loss for this company, which is definitely problematic. And look, what company can do? Like, the company cannot influence the exchange rate, especially a small company producing bikes. But this is when forward markets come into place. Because look, what Polish company can do is that Polish company can use a forward contract. For example, it can make a contract with another company, and this contract is going to sound like this. In 1 year from now, we are going to buy, we are going to sell you euros, and we're gonna sell you, we're gonna sell you 100,000 euros, and each euro we're gonna sell you, you're gonna for each euro we're gonna sell to you, you're gonna pay us 3 zloty and 50 groszy. Well, in this case, definitely the company can mitigate the possibility of getting the exchange of having volatile exchange rates. Look, of course, now none of the speculators are going to do this for free. You will have to pay for the privilege of getting euro at this particular exchange rate. Getting zloty for €1 at this particular exchange rate. But so is this profitable? Well, let's see. Look, in this case we see that profit function did not change, but now we have this fixed exchange rate, and with this fixed exchange rate, at which we're going to be able to obtain zloty for euro, the company will be able to get 3,500 zlotych per bike, and consequently make 5,000 zlotych, 50,000 zlotych. Now, if the company offering forward contract would want for it only 20,000 zlotych or 10,000 zlotych, the company still could make a decent profit on selling the bikes. But of course, look, this could be very risky. Why? Look, because what if, for example, the exchange rate of zloty is actually depreciating? Well, in this case, the company could sell each bike for 5,000 zlotych and make 20,000 zlotych. So in this entire transaction, it would lose 15,000 that they could have made, plus what they paid for the contract. But look, the rule is that companies actually want to avoid uncertainty as much as possible, and companies actually prefer to pay to make the profit sure than to play the gambit and try to obtain and try to risk losing everything. Okay, so look, I hope at this moment you know why different agents would like to engage in forward markets. But now let's just describe some of the most commonly used forward instruments. Okay, now those instruments that I'm going to describe to you right now are called plain vanilla, because those are the simplest instruments, and in a different subject like investment analysis or finance, uh, you will learn about more complicated instruments like derivatives. Because we are focusing here on international finance and international economics, we're not going to get into details with those instruments. I just want you to know how the three main instruments works. So first is outright forward, or we're going to be calling it forward for sure. This is a transaction involving exchange of two currencies at a rate agreed on the date of the contract for value or delivery at some time in the future. Now, look, what does it mean? Look, this is exactly the transaction that I've described to you before. The company was worried about the future exchange rate and about the potential loss. So they agreed upon with some other company how much, at what price they're going to exchange currencies in the future. And of course, for this privilege, the company needed to pay some extra to reward the other company for doing so. Okay, the second instrument is called foreign exchange swap. And look, we're going to call it swap for short. And look, this instrument is like made into two parts called short leg and long leg. Let's discuss them in turn. So look, this is a transaction that involves, a actual exchange of two currencies at a specific date at a rate agreed at the time of conclusion of the contract. So look, what is what is happening over here? Two companies are agreeing to exchange currency, two agents basically, at a given price, and they do it at the very moment when agreement takes place. Then, after some period of time has passed, the reverse exchange of the same two currencies at a future date takes place, and they exchange currencies back at a different exchange rate. This is called this long leg. And now, look, why would these companies do this? Look, if they predict some movements in exchange rates that could favor them, they should they should engage in such a contract because they can make they can make the profit based on the difference between actual value of exchange rate and the exchange rate in the agreement in which they participated. And then finally, a currency option, or option for short, is the contract that gives the right to buy or sell currency with another currency at a specific exchange rate during a specific period. So look, again, you are going to let's just say that our bike company goes to other company, and let's just say that our bike company is not having one contract. Let's just say 6 months from now, but is constantly selling bikes to different companies over and has contracts over next 2 years. So what they can say, they can buy option and pay a company that this company is going to be selling them a zlotych for a given amount of euros, and because of that they can maintain stable level of profit without any worries about the exchange rate. Of course, in this scenario, we need to take into consideration the fact that our company is not going to be able to do it for free. It still needs to pay for the privilege of getting the currency at a different rate. But look, exchange rate can change favorably for the company if Polish zloty depreciates, or unfavorably if Polish zloty appreciates. And this is why it's called an option, because you don't need to do it. You just use this option only if it's better than spot exchange rate at a given moment. Okay, so now let's look at the differences between spot and 3-month forward exchange rate between Australian dollar and United States dollar. Look, actually, as you see, the two rates are following each other very, very, very closely. But there are some periods of time, like, for example, the one you see over here in 2007, when most of the companies, most of economic agents were expecting depreciation, and depreciation was taking place, where spot and forward were basically the same. Well, but over here you can also see that in the 80s, although we had and especially at the in the middle of the 80s and at the end of the 80s, there were situations in which spot and forward were two very different prices. Well, maybe not very different prices, but you can make but the spread between them, which is called either premium or discount, which gonna discuss in a little bit, it was relatively big. Okay, so now let's go to what are premiums and discounts. Look, if we have a situation that spot exchange rate is lower than forward exchange rate, we say that the currency is sold at a premium. And look, we're going to get back to this notion a little bit later in detail, but existence of a premium is an indication that markets expect appreciation. This is why the forward is higher than spot exchange rate. Then, if the other is true, if spot is bigger than forward, it means that the currency is sold at a discount. And the existence of a discount implies that there is an indication that the markets are expecting depreciation. Now, look, how can we calculate a forward premium or a discount? Well, if we want to calculate it as an annual percentage, and let's just say the duration of a contract is expressed in months, then we calculate it as a difference between forward and spot divided by spot, and this whole thing divided by duration over 12, because we have 12 months in a year, and this will give us our premium expressed in percentages. So how many percent we can make if we engage on a forward transaction with some company. Okay, so now let's look at the premiums. Look, as you see over here, those premiums are volatile, and we see that there are sometimes we actually see the premiums, sometimes we see discounts, and there is also a great volatility in them, especially in terms of great uncertainty, like over here when we had sovereign debt crisis. But as you see, they are moving. They can actually get to a very, very big numbers, from ranging from almost 25% the premium to less than 15% discount. Okay, now look, all that we've been talking about thus far are so-called effective exchange rates. Bilateral exchange rates. So those are the exchange rates between two countries only. Look, this is exactly what we saw before over here. Look, when we had these, here what we see is that, look, British pound For example, here we see green, 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 red, green, 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 green. Over here, red, green, 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 red, green, green, red. So what is this telling us is that both British pound and US dollar is appreciating against some currencies and depreciating against some other currencies. So with just the knowledge of bilateral exchange rates, can we actually learn anything meaningful about the behavior of a currency, whether this currency is actually getting more or less valuable? Well, look, we can get this, especially when we compare, for example, euro to United States dollar to yen to a pound, because those are major world currencies, and they give some indication of how well the currency is doing. But there is a better way of approaching this problem, and this is by calculating effective exchange rates. Effective exchange rate is an index summarizing the overall movement of countries' exchange rate. And look, let me explain how it is work. Look, we usually calculate it in a following way. This is the exchange rate, effective exchange rate at time t is equal to effective exchange rate at time t minus 1 times, here we have product symbol, because you can think about it as a weighted geometrical average. Here we have spot exchange rate at time t divided by spot exchange rate at time t minus 1. So here we have a relative change in exchange rate. But look, this spot exchange rate has index J, because here this is a bilateral exchange rate with some partner country J. And J, capital letter J, denotes the total number of countries. So look, we take into consideration now changes in exchange rate with all the partners. But again, as we said, there are some major currencies. Some currencies are more important than the others for different economies. How should we decide? Well, we assign weight to each partner. This weight can be calculated in various different ways, but the most popular one is simply by trade share. So if, for example, 20% of American trade is with China, then they can use weight of 20% for bilateral exchange rate with China. If 15% is for the trade with euro area, they can use 15% weight with euro area. And then we get as a result an index that is telling us how much, how on average the behavior of the currency can be described. Of course, we mean here by average the weighted average. Okay, now let's look at real effective exchange rate. We didn't talk about real exchange rates. We're going to do it in the next video when we're going to discuss purchasing power parity. But that was the only, I couldn't find nominal exchange rates anywhere else. If somebody will be able to do it, please let me know. Look, I have here data from Federal Bank of St. Louis and actually from Bank for Settlements. And look, here is the real effective exchange rate for United States dollars. With United States dollars. And look, this is a broad effective exchange rate. What does it mean? It takes into consideration basically every country with which United States trades. And here we see the behavior. We see that there was a period of appreciation right up till 2000 and dot-com bubble that you see over here in a shaded area. Then there was area of general depreciation right up to the 2008 crisis. And then we see that the value of the currency has been bouncing back ever since. Now, however, what I wanted to tell you is that this broad effective exchange rate can be misleading. Look, over here we have trade weighted uh, real exchange rate, but calculated only for major world currencies. And look, we see that it actually is way flatter and is characterized by less volatility than than the previous one. Why is it like that? Well, the reason is very simple. Look, in case of the broad real effective exchange rate, we have a lot of different currencies. And if we have a hyperinflation in some country, then the value of this currency can drop significantly. And even with a very small weight, it can account for a very big part of the exchange rate, but that has nothing to do with the well-being of American currency, but rather reflects a very bad situation in a country experiencing hyperinflation. This is why these indexes for major currencies are very important, and when you look at the weighted average for non-major currency, you need to take this into account. Now, look, here we have broad effective exchange rate for Euro-area, and here again I said an index so that 100 is 2010, and here we can see observe the behavior of the exchange rate of the European currency. Now, you might ask, how is it possible that we have the values over here? Because euro actually came about around 99 in transactions without, actual currency, without the notes and coins. But remember, we based on the baskets associated with European monetary system, they still can be calculated, and this is what you see over here. Okay, and finally, I wanted to put your attention into the importance of global foreign exchange market, especially when we compare it with global trade. Global trade. Look, in 2019, the value of global trade was about $22 billion. This, I'm sorry, $22 trillion, because $22 trillion, which is a ridiculously big amount of money, right? Each of us can say that this amount of money is tremendously big. But now let's look at foreign exchange market turnover. And what is happening in 2019? We see that the turnover on this market is around, look, let's just say 6.5 billion. Oh, you might say, well, that's quite a lot. But this is actually a little bit less than trade. But then look at the top of my slide. This is not for the entire year. This is for one day. This is the average turnover in foreign exchange market in just one day. And look, this is only concerning actual trade in currency and instruments, plain vanilla instruments. It's not counting derivatives. So as you see, this the importance of this market cannot be overstated. Okay, another important feature of that graph is that what we see, let's start with total, all instruments. Look, what we see over here is that the volume of trade of trade in all instruments has been rising extremely fast over the last 30 years since it was actually started being calculated. And look, now let's look at the proportion. Look, spot used to be the most important transaction, and the number of spot transactions is actually still growing, but now the most important transactions are forex swaps that we've been discussed before. Now, forwards, as you see, are the third most important instruments, but they are not as crucial as the other ones. And finally, options are taking the fifth place, and currency swaps are the last ones. Okay, so I believe that this is probably quite a lot for one lecture. So I want to thank you for your attention, and see you in the next lecture when we're going to be discussing purchasing power parity. Take care.